Jeffrey Beckham with Jamestown Properties. We are a vertically integrated real estate investment manager that invests across the real estate spectrum, specializing in core and opportunity assets. Over the 27-year history, Jamestown's invested in over 80 properties, totaling over 25 million square feet through 26 core funds and 5 opportunity funds, with about $3.3 billion in equity. We have about over $4 billion of assets under management today. I think what we saw in the kind of late 2000s, mid 2000s, where you could, in real estate allocators, could invest in properties and just wait for a cap rate compression in the markets to take them out of their investment. Now you really need more active management for real estate that produces managers that actually value add, vertically integrated managers that are close to the real estate, who actually have to earn their returns versus waiting for the market to take them out. For example, Jamestown has a creative department that focuses on value add aesthetics, creative solutions to real estate assets to really renovate a lobby, focus on retail, right tenant mix on properties, and really earn those returns such that a real estate investment manager has a better chance to achieve the target returns it's looking for than one that's just literally putting capital and waiting for the capital markets to bounce back. I think in the equity markets, they never went away. The debt markets are starting to come back now, but the big question right now is supply of product. So pricing for assets isn't driven by fundamentals, it's driven by the supply-demand imbalance of equity and, to some respects, debt capital. So there's so much money chasing deals, and there is availability for debt out there at different levels than it was in 2006, 2007. So you're seeing equity there, debt is starting to come back. The problem is real estate fundamentals aren't supporting asset valuations, capital markets are. Yeah, one of the areas that we're really focused on is gap equity. So, looking at distressed real estate situations with borrowers, instead of looking to buy the note, working with the borrower to actually invest in the capital structure, maybe on a preferred basis, where you're getting a chance to invest in quality real estate at a reduced basis, possibly in a preferred position, but you're not in an antagonistic relationship with the borrower because you're buying the debt at that point and trying to foreclose. It's a much cleaner situation, and you exercise more control over the asset because you're actually in an equity position than in a debt position. You have more ability to affect the business plan of the asset. I mean, Jamestown has become more vertically integrated. We property manage many of our assets over its history. Jamestown has property managed over 15 million square feet. So we're actually looking to take over property management for more of our assets and take leasing in-house where it makes sense to exercise more control over assets and employ strategies discussed further that are really going to force us to, quote, earn our money on our assets versus playing the capital markets game.